Are you looking for some nice dividend yield now with the potential for some fabulous upside, some capital appreciation, as well as increasing dividends into the future? Then I have quite the nice opportunity for you today. Well covered dividend, good stable sector, and with a merger just completed, some powerful positive upside potential here. Let's get into it. Okay, Healthpeak Properties. Now, this has just completed the merger with Physicians Realty, which I've covered before, particularly in contrast with the medical trust. What we see here is we can see that prices have come down as they have with many REITs over the last several years. And we can see the history here before merger is somewhat choppy here for Healthpeak. Now, post-merger, what we're expecting to see is this forward-looking increase here. It's not particularly large, it's not particularly strong. 2024 is expected to be 0%, moving to 6 and then 5% increases for the AFFO. Now, usually a fairly good track record here with the analyst scorecard as well, 75% of the time hitting or beating the estimates. And here we can see they get the estimates right about 83% of the time, 2 years in advance. But they miss about 17% of the time. So not too shabby. Now, at a what level, what does this mean in terms of return? Now, here, because of the merger, I'm taking some of this with a grain of salt. I think that Physicians Realty, they've got a number of seats now on the board. I believe the board at Healthpeak's been expanded from 8 to 13. Now, that brings on board the Physicians Realty expertise, and I think they did a much better job in terms of the management as well. So I'm expecting to see less of this and more of a slow and steady growth. But we can switch over from here, though, to the forecasting tab. And I think here, if I keep it on the 15 times, I think that's reasonable given the growth that we're looking at. And if prices do accelerate and return to the price to AFFO ratio here of about 15 times by the end of 2026, and the analyst estimates are reasonably accurate, then we should be looking at a total rate of return of about 17.8% per annum. Now that's a combination, of course, of the dividends here of 6.5%. Plus the AFFO growth, which is really kicking into or expected to kick into gear in 2025 and 2020. Now, another thing that I do like to look at is how the analyst expectations have been changing. So here, for example, the 2024 analyst expectations have been relatively constant. When I look at 2025, they've improved marginally over the last 6 months. And for 2026, there's fewer analysts reporting, which is important to note as well. But we see that the analyst expectations have weakened somewhat. Now, as well as this, we can also see that there's an expectation by analysts after the merger that we're going to see some accelerated dividend growth here, and this is assuming, of course, that we hold everything steady. I'm making this sound absolutely fantastic, and is this reasonable? Even here at the end of at the start of 2023, we could see that the company was trading at 19 times in a price to AFFO ratio. So I think the return to 15 times is entirely reasonable, particularly given that we're only currently at 12 times AFFO, price to AFFO ratio. Some of the things I don't like, though, the long-term debt to capital is relatively high here. Not too unusual, though, for a REIT of about 50%. The market cap's, say, a good solid $13 billion. So giving me a sense of some security here. Okay, so when I begin to think about Healthpeak Properties now, what exactly am I looking at? Oh, it's definitely in the medical space, and it's definitely, of course, a real estate investment company. So it has some comparabilities like Alexandria, ARE, with which we also have a long-standing position in our family portfolio. The difference with ARE, as well as the sort of the office properties, it also has a very large segment of healthcare and hospital assets now as well. And I think it's around 50% life sciences like ARE, then about 40% in the outpatient medical care. So fairly good, fairly stable. Now, One of the reasons that I'm interested in the company is, of course, this part here. The balance sheet is in great shape. So 5.2 times net debt to EBITDA, which I think is good. It is solid. It's not very leveraged in this sector. And they also have a huge amount of liquidity actually on their books at the moment. Now that's going to give them quite a few options. Now here with Koifin, this is one of the things I do like about the platform here is I can quickly type in a term and this can give me the ability to quickly search through here. I can scroll down here. I can get a snippet of whether or not this is what I'm looking for. And then it can pull it open for me in the main transcript of the earnings call. And I can see whether or not this is what I'm looking for and understand a bit more about the context. Now, if you do want to try the Koifin platform, please do use the affiliate link in the comments box down below, the description down below, and that will give you a 15% off as well as a small kickback to me also. This is one of the key platforms that I use along with FastGraphs, so you'll see me switching between the two. They are quite different, but here, of course, this is the good use here, where I'm looking at through the earnings calls. Now, this is also another point here as well. With the management of their debt and their positive outlook here, they've also managed to upsize their 5-year term loan quite a bit as well and swap the entire amount to a very nice fixed rate here of 4.5%. And I think that's a strong sign of confidence here in the market and by the board and the management team as well. Now, one of the big reasons that I'm quite bullish on this company at the moment is this merger. Now, the merger is suggesting that they're looking at $40 million of synergies. Some of these are operational, some of these are going to be flowing through to the NO. And it's also important to note as well that this is a true merger. It's not being pushed by shareholder perspectives or anything, but this is two strong, well-managed companies that are looking at each other. Well, I think October in 2020, we're now early in 2024. These companies looked at each other, they basically checked each other out and they decided that there was a lot of benefits to combining and merging and that they'd be stronger together than they would be apart. And so in terms of mergers, I think this is a very sensible, very logical one. The portfolio is looking good here with occupancy at about 97%. Tenant retention was approximately 80%. So I think this is looking good for me as well. Now, I do know one other benefit of this company as well is they are well diversified. So one of the difficulties that I did have with Medical Properties Trust, MPW, one of the things that led me a little bit astray was a high level of concentration, which is something that I'm desperately trying to avoid in the future. Now, Healthpeak Properties, I believe when I looked through the tenants here as well, the largest tenant is about 9% of the portfolio, second largest is about 3%, and then beyond that, it's about 1% or below. Reasonably good diversification and spread all over different parts of the USA as well. Another really beautiful thing about it is it doesn't actually have any 2024 maturities. The 5 maturities are less than $1 billion and they've got enough liquidity actually on hand as well to cover 2025 and 2026 and most of 2027 as well. So plenty of liquidity there. So this is a company that's been managing their debt effectively as well. One of the things to look at here as well is valuation. Now, when I look at price to earnings, it's not so relevant. Price to sales here is a bit more relevant. Price to book is more relevant for a REIT. Unfortunately, here on the Koifin platform, it doesn't have the ability to add to this. Here, I would also be adding a metric related to REITs specifically, but we can see enterprise value to EBITDA also very good compared to their history. Dividend yield is looking good. Buyback yield's looking good. Leverage levels are looking very good as well against their history. And then, of course, when I begin to go back to the FastGraphs platform as well, is it looking good? It's always hard to be sure of these valuations. I'm going to shorten the time frame here as well. And we can see here that in the last several years, they've been trading at about 18 times as a PE ratio. I think it's a little bit overblown. I think here what I'll be looking at is about a 15 times. They're currently trading here then at 12 times on a price to AFFO ratio. rather than 15 times. So in terms of the valuation, I think this is strong. I think this is solid. I think this is a good valuation. It doesn't fully mitigate downside risk. You can see here, for example, the valuation is better and safer than it was in the pandemic. And I think even here, if we look down a little bit further, and even if we assume that the price has decreased, I think there's still the potential here for a rebound in prices up to this 15 level in the next several coming years, particularly with this modest AFFO growth. So I think that the price and the valuation right now are looking good. Now, is it likely to hit these targets? If I use forecasting calculator and this 15 times price to earnings multiple, is it likely to hit that? The answer is yes. I think that's very reasonable expectations here. Even if I drop the expectations down to 13.5 times on a price to AFFO, I think it's very achievable. But here we also have a total annualized rate of return of 14%, still not too shabby. In a shocking case, even if it goes sideways almost, in fact drops here down to a price to AFFO ratio of only 10.5, we're still going to eke out a total annualized rate of return. Although it's important to note from this box as well that this is going to be driven not from the price movements here, but instead from the healthy dividend yield. So this is one of the reasons that I do like dividends. Even if prices go nowhere, I'm still going to get a rate of return. If prices go down, despite this strong, compelling growth here, this good, strong, compelling growth in the future here for the AFFO, if prices go down, that doesn't matter too much because I can fall back on that dividends to give me a buffer. So overall, what am I looking at here? The answer is quite simply, I think this is a nice healthcare REIT now. I think it's got a good portfolio. I think the fundamentals are looking good for the company. I think the valuation's right. I love the synergies from this merger that they've been talking about between Healthpeak and Physicians Realty. The debt is manageable, few maturities in the future. I'm liking this. I think with the healthy dividend yield, we can see a reasonable rate of return, even if prices don't go very far or even decrease. So I think this is a reasonable buy at the current prices here, looking at 18.5 a share. Now, of course, another potential play on this would be to look at options as well for many retail investors as well. This is at a price level where it is possible to sell some cash secured puts and also begin to decrease the actual price it would be paying for the shares in that way as well. One final point is that the dividend payments here are going to be well covered. So dividend payout here for 2024 estimated to be about 74% on an AFFO level, which I think is nice and secure. It's well covered. The company's well run. I think there's some good upside potential here. Valuation is good. And so I think we're looking forward to some nice AFFO growth. So this for me is a good buy and certainly one that I'll be keeping a much closer eye on. So what about you? What do you think? Is it something that you've already got in your portfolio? Physicians Realty is one that I've looked at in the past on this channel. It's one that I've compared to MPW as a potentially slower grower, but also with a healthy dividend yield. And I certainly feel that this is a much better fit for me now, certainly more so than MPW. This has got much more stability, much more security. Let me know in the comments down below. What do you think?